Hi there, thank you so much for joining us today. My name is Sokha and I'm a financial wellness counselor here at Mayo Employees Federal Credit Union. I've been in my position for almost 2 years, and prior to that I was in collections for about 16 years. So financial wellness and financial literacy is something I'm very passionate about. So today, as you're aware, we're going to talk about student loans 101. We're going to have some frequently asked questions towards the end of the presentation. And if you have any questions at any time, please just go ahead and type in the questions. And Seth will go ahead and ask the questions, and I'll do my best to answer them. Or if you want a more personal, sit down and talk to me about your student loan situation, you're more than welcome to reach out to me. My phone number or my email address, it's available on our website as well. So you can reach out to me and we can touch base and schedule an appointment for us to meet. So that way you have a one-on-one attention on you. So today we're going to talk about paying for college, federal student loans or FAFSA, when and how, when you should apply, how to apply for it, identify your current student loans, where to find them, what kind of loans you have, understand your repayment options. So there's just a lot of new things that's rolling out. So we're going to talk about the new Biden Save Plan, but that's, might be changing and stuff too. So we want to go ahead and talk about what's available to us today as of August 9, 2023. And as things, roll out and change, we can always address that in our upcoming presentation as well. Going back to FAFSA, there's some changes in FAFSA that we'll address too. And also we want you to prepare for your repayment and how to go about doing that, okay? First of all, paying for college. So sometimes, if you're lucky, you have parents or grandparents, whomever in your family that have a college savings plan set up for you. This can look like a 529B plan or investment plan, or a CD or just a regular savings plan that someone has set up for you. You can do that yourself too. Once you start working, just save up as much as you can and set to aside to pay for your college. But if you're interested in opening a 529 plan for your kids, for them to go to school later on, you're more than welcome to reach out to us here so we can open up a plan for you, or we can send you over to the investment team if you have more questions on the investment side. Another way to pay for college would be for getting student loans, private and federal student loans. So the difference, we're going to talk about the difference. We're going to talk about scholarships that Mayo have available and that Mayo Employees Federal Credit Union have available as well. So before each college year, students can apply for federal grants, work study, and loans with a free application, federal student aid, which is FAFSA form. Your college uses your FAFSA data to determine your financial aid eligibility. So there's some changes here that was made. So it's a new redesigned FAFSA expected to launch in December 2023 for the 2024-2025 academic year. And a delay from the typical October 1st release date. So you can still submit your 2023 and 2024 FAFSA until June 30th of 2024. There's going to be some more FAFSA deadlines updated as well. So all college students attending eligible schools qualify to submit their FAFSA form. And there are some eligibility for you to be aware of when you apply for FAFSA. You have to have a high school diploma or a GED, or have completed a state-approved homeschool high school education. You have to be a U.S. citizen or an eligible non-citizen with U.S. status, such as a green card, an arrival departure record like an I-94, battered immigrant to qualify alien status, or a T visa for a parent with a T1 visa. You should have a valid social security number, be enrolled or accepted for enrollment in an eligible degree or certificate program, maintain satisfactory academic progress in school. And as of 2021-2022 award year, FAFSA no longer requires you to be selective service registration prior to receiving federal student aids. So previously, males between the ages of 18 to 25 who aren't already in active duty have to register for you to be eligible for federal aids. So that's no longer effective. So additionally, individuals who are convicted of drug-related charges while receiving federal aid will not have their aid eligibility be suspended, and these questions will no longer be asked on FAFSA forms on 2023 and 2024. So that's a new thing. And also by the time so when to sign up. So we addressed that. So for the 2023, 2024, you have until June 2024. So by the time you're 24, you're considered independent. So in the 2023-2024 school year, you're independent if you were born before January 1st, 2000, excuse me. Independent students have higher borrowing limits than independent students. You're also considered independent if you're married, a veteran, or in a graduate program or have dependents of your own. If you're dependent, you have to include both of your parents' information on the FAFSA. And if you're independent, report only your information. Even if you're married, you don't have to include your spouse's information either. So, if you're independent and married and filing jointly, then you have to include your spouse's information. Okay, and now we're going to talk about how to successfully repay your student loans. First of all, we want to identify your loans. So do you have federal and private student loans? In order to find that out, you can go to studentaid.gov. If you do not already have an account, you can just create an account, and that way you can log in and see what kind of loans you have. Another way to see what kind of loans you have, you can also go to your credit report. You can access free credit reports by going to annualcreditreport.com. Like I said, it's free. You don't have to pay for your scores. It's not really important to see your scores off of that at this time. We just want to see what kind of student loans you have at that time or currently. So you want to identify your loans, Federal Student Aid website. What kind of loans do you have? Is it subsidized, unsubsidized, or private loans? And are your loans eligible for the Public Service Loan Forgiveness Program, otherwise known as PSLF program? So first of all, subsidized loans is education department pays your interest while you're in school. So this is what it might look like. You can have, you can have 3 subsidized loans equaling out to $39.80. And then the principal will be the amount of, let's say the first one is $1,291. The interest is $1, so the total balance will be $1,292. That's because Department of Education is paying for your interest while you're still in school. So subsidized undergraduate and graduate or professional degrees have higher loan amounts. So this will be for your professional one you can be eligible, as you see in this one in 3 unsubsidized loan example, it's a higher amount available to you to borrow. And understanding your repayment option. So the standard repayment option is typically 10 years. The graduated program is payment increase over time. So if you're starting out with a smaller monthly payment because you're starting lower at your position, and as you progress in your career, your monthly payments will increase as well. So that means your payments will increase over time. An extended period will be repaid for up to 25 years. Okay, and then income-based payments are calculated based of income and family size. So there are a few different options under the income-based program. Pay as you earn. Revised pay as you earn, income-based, and income contingent. And then also understand repayment options for your private student loans that's not the government. So private student loans would be if you come to us and you apply to consolidate your federal student loans or your private student loans, then because we're a financial institution, we're a credit union, be considered as a private student loan, okay? So, and it's based off of lenders' policies and regulations, and a cosigner may be required if your credit score is not where it's at, if your income is not enough to support that, the repayment option. So you might need a cosigner. And cosigner can be released after meeting requirements. Do we have any questions currently, or just continue on? Okay, good deal. And wonder what kind of what different loan amounts and repayment types could look like for you. So typically right now, most student loans balance are usually about $37,000. If you're on the standard repayment program, then you're probably looking at about $394 per month. And by the time you pay off your student loans, you're probably going to pay a total of $10,000 in interest, okay? At a graduate standard repayments, the typical payment on $37,000 is $222. The total interest is going to vary because remember, you're starting at a much lower payments at the beginning of the time of your loan repayments journey, and then it eventually just grows larger. So the interest is hard to calculate on that. The extended repayment program, remember this is a longer You can take up to 25 years to pay off your loan. So the payments is the smallest one at $216. But by the time you pay off $37,000, you're probably looking at about $20,000 in interest paid, okay? The repay program, the revised pay as you earn, you're looking at about $350 per month, but then your total interest is $12,000. And if you decide to consolidate to a private student loan, or refinance, so we'll use consolidation refinance interchangeably. With us here and with our current interest, you're probably looking at about $303, paying a total of $17,418 in interest paid on $37,000 student loans. Okay, so that's over 10 years. The graduated program, 20% increase every 2 years. The extended repayment, 300 payments over 25 years. That's why the interest is the highest on that one. The repay program is 140 payments over 11 and a half years. And the MEFCU consolidation with us here is roughly 15 years, 180 payments. So wondering what different types of repayment looks like. So this is going to be for if your loan is $50,000. Okay, so again, 120 over 10 years, you're paying roughly $530, $13,600 in interest paid. And graduate program, of course, it increases over 20% every 2 years, but your payments is roughly looking at about $300. The extended pay repayment, excuse me, looking at 300 payments over 25 years, that'll be $292. But look at the interest paid on that one, though. It's $37,700. So and so on and so on. So this example is for $50,000 in student loans. The previous example is for $37,000. And so we want to take a look at federal consolidation. So you can have two types of loans, subsidized loans and unsubsidized loans. We're going to look at private loan consolidation, consolidate both federal and private loans into one loan, so that way you only have one payment, okay? The repayment term can be 5, 10, or 15 years. And consider multiple options and terms. So remember, whether you come to MEFCU or you go to another financial institution down the street, these private student loans are based off of their regulations and terms. So it's really important that you ask all the appropriate questions. Okay, and pros and cons, or the pros of private consolidation: manage fewer loans, meaning that all of your student loans, so for example, when you have federal student loans, chances are you have more than one. It's going to be a few student loans, but they just give you one payment, and with different interest rate on each loan as well. So with privates, when you consolidate to a private consolidation, you have a lot smaller, just maybe one loan, but it's one large loan. You can save money with a lower interest rate as well. So if your credit is good and you think you want to go ahead and consolidate to a private student loan for a very low interest rate, might as well do that, so that we can save money. But if you don't think your credit's good enough, you can always get a co-signer to do that as well. You can improve your cash flow with a lower monthly payment, so that way you have more money for food, for gas, for entertainment, for life. And you can always release your co-signers sooner too. So for example, if you have private student loans before and your parents were co-signers, but now that you're older, you're working, you're now getting your adult money, and your credit score is a lot better than when you were much younger, you want to go ahead and release your parents and whoever was the co-signer. So you consolidate under strictly your name and release, and it pays off the last loan, so that way you're no longer tied or attached to a co-signer. The cons would be your forfeiting benefits provided by federal loans, such as the forbearance that we've had, the pandemic pause that we've had for the last 3 years. So that's what you're forfeiting. So if I can afford my student loans, what do I do? You can talk about forbearance, postponing payments. Interest continues to accrue, which can cause the balance to increase, of course. So we want this to be as temporary as possible, but you can also make changes to your expenses and lifestyle to better afford your student loan payment. So we can talk about, a lot of people when they come see me and they said, I'm really worried about my student loan repayment. The amount that I paid last time that I was paying it 3 years ago is not something that I can afford at this time. Inflation has gone through the roof. I now have a house. I now bought a second car. We now have a child or 2 kids in daycare. I can no longer afford the payments that we have before. So what can I do then? So if you do not want to go into forbearance, or let them know that you cannot afford it, you can also sign up for a new SAVE plan that the Biden administration rolled out, which we'll attack here in just a little bit. But also you can, when people generally meet with me, we'll go over your budget. We can see where we can cut out some expenses and increase some income. So it's more of a money flow situation that we want to work with. We want to cut out some, lifestyle. We want to make lifestyle changes. If you were eating out $800 a month before, we might want to scale that back down to maybe $300 or $500 a month. If you were traveling a lot before, we want to go ahead and scale that down to maybe once or twice a year in order for you to afford your student loan repayments, okay? Now, the pandemic forbearance, the CARES Act forbearance and interest pause effective March 2020, and it's going to end on September 2023, and payments resume October 2023. So it's really important that you take a look at your budget. You talk to your family and friends and see if there's something that you can, if you're able to rent out a room in your house, if you're able to change up your living area, if it's going to be cheaper for you to move out of Rochester or go to a smaller town somewhere else, just to make sure that you readjust your life according to your repayment options, okay? So we're going to take a look at some frequently asked questions. Should I consolidate or refinance my student loans? Well, consolidation might not be the right choice for everyone. Depends on the current rates, the type of loans, the federal versus private, and a cosigner release. If your goal is to go ahead and get a smaller, if your goal is to go ahead and make things easy for you and have one payment for all of your student loan, then by all means do it, because like I said, with the federal student loans, you may have, upwards of 10, 15 loans at a time and different interest rates. You don't know where your payment is really going to. You're making one payment per month, but is it being applied to the higher interest rate one, or is it being applied to a loan that was from 5 years ago? So you have better control when you consolidate it into a private student loan, because then you get one interest rate and you get one balance, you get one payment that's the only thing you have to worry about. And what is the best way to pay off student loans faster? Well, if there's no repayment penalty to pay off your student loans a lot faster, so you can pay it at any time. You can always refinance or consolidate your student loans. You can lower your interest rate, saving you money and making extra payments to reduce your principal balance and save money on the interest. So you can probably, if you consolidate your your federal student loans to private, you're looking at, let's say they tell you to pay $500 a month for a $60,000 student loan that you consolidated. You can actually just, make an extra payment each month by getting a second job, or be able to pick up overtime where your job is at now, or sell items. There's a lot of different things that you can do to pick up extra money throughout the month. So you can actually pay $500 towards your regular payment, and then the second time of the month, later on that month, you can probably just make an extra $100 payment and have it paid towards principal only. So that way you can attack the principal a lot faster. And when you pay down the principal a lot faster, your balance comes down faster, meaning that you're going to pay a lot less in interest, okay? Do we have any questions so far, Seth, or do I just continue on?
Continue on.
Okay, perfect, thank you. And so what if I cannot afford the payments? We can enroll in the income-driven repayment program, or SAVE, the SAVE program, which we're going to talk about here in just a little bit, or get a second job like I mentioned earlier. How long does it take to pay off student loans? The standard repayment is 10 years, and we went over that just a little bit ago with the extended and the graduated program. Can I deduct student loan interest from taxes? Yes, you can. You can qualify to deduct up to $2,500 of student loan interest per return each year. So you can claim the student loan interest tax deduction as an adjustment to income. You do not need to itemize deductions to claim it at all. So that's something for you to keep in mind too. So once you start payments this year, by the time you get your W-2s next year to file your 2023 taxes, you can deduct your interest that you paid this year on your student loans. If you have more questions on that, I recommend that you talk to a tax professional about that. You can, when it comes to tax time, there's a lot of volunteers that do taxes for free. So go ahead and have your questions about student loan taxes available and ready to ask them. So it's something that's great to take advantage of. And how do I remove my student loans cosigner? You can refinance or consolidate the loan. How do I know who to pay and when to? How do I know who to pay and when to federal student loans. You can pull up your credit report, or you can just log on to studentaid.gov. Do student loans affect my credit score? Yes, your student loans and the amount and payment history will go on your credit report. On-time payments will help you maintain a positive score. Failure to make payments can, of course, hurt your score. So just like anything that is revolving, like your credit card, your car loan, your mortgage, personal loans, any kind of loans that you have out, it has to be reported on to your credit report each month, and it has to be reported accurately. So if you start falling behind in your student loan repayment, of course that affects your score negatively. But before you get to that, you might want to just go ahead and reach out to your student loan service provider. Let them know of your financial hardship. Let them know ahead of time before you fall behind, before it really affects your credit score, your credit report. So let them know what's going on. They can have other options to explore to put you on a lower, repayment plan. So maybe this year your job and everything is going great. You're making great money. Something happens next year to where you're not able to work full time anymore. You really have to scale back, and your income is a lot less. Don't be afraid to call them up. Let them know of your new financial situation. Okay, and. Can a creditor ask me about the alimony, child support, or separate maintenance payments that I or my co-signer receive when it comes to applying for student loans? They may ask whether income stated in your application comes from alimony, child support, or separate maintenance payments. However, the creditor must tell you that you do not have to reveal such income if you do not want to. And lastly, we're going to talk about the Biden Save Plan. So this just rolled out perhaps a month or two ago. However, the application to apply for this program just rolled out about 2 to 3 weeks ago. So they released a beta application, and I highly recommend that you go and apply as quickly as possible, preferably before student loan repayment starts. You can go to studentaid.gov and just type in the Save Plan application, and they'll go ahead and direct you to that. So to talk a little bit more about it, so the Save Plan, it stands for Saving on Valuable Education. It's an income-driven repayment plan. It actually replaces one of the income repayment plans, the revised pay as you earn, so the REPAY program. So instead of paying 10% of borrower's discretionary income a month towards your undergraduate student loan debt under the REPAY program, what's changed now is that borrowers will eventually be required to only pay 5%. So what that looks like is if your payments before was out of $1,000, so 10% of your discretionary income is $1,000. They would have you required to pay $1,000. So now you only have to pay 5% of your total discretionary income, or 5% of your discretionary income for your total income. So that's a lot more doable for a lot of people. And borrowers making under $15 an hour won't need to make any payments at this time, or once they apply for it. So previously, a borrower who made, so as an example, a borrower who made $40,000 a year would make a monthly income loan of about $151 on this new SAVE program, where the REPAY program before would have, the REPAY program would have had them pay $151. With this new SAVE program, they would only have to pay $30. And it's, for example, if someone making $90,000 a year, that would shrink their payment from $238 per month to, from $568 per month to $238 per month. Most borrowers should qualify for the plan as long as their loan is in good standing. And you can apply for it now, but it actually takes effect in July 2024, because I'm pretty sure more things are going to change for this SAVE program. So just keep an eye on the news. And of course, we'll have more presentations as things change as well. So to enroll in the SAVE program, you should do it now before bill starts in the fall for you to see, certain borrowers will see certain benefits a lot sooner. For example, if a single borrower earning less than $32,805 per year, you will not have to make any payments, but we want you to enroll in it's always important for you to enroll in that program, get accepted, knowing that your payments are going to be at zero for a while. And higher share of your income will be protected from your monthly payment calculation, just like the example we did before. An agency will cease charging any interest that is not covered by the borrower's monthly payments. Also, married borrowers who file their taxes separately will no longer require to include their spouse's income to get their payment calculations. And again, things will continuously change for the better, hopefully. But in order for you to apply, just go to studentaid.gov or type in the SAVE plan, the Biden SAVE plan, and they'll go ahead and direct you to the application. Okay, go ahead.
Do you want to touch on student public loan forgiveness a little bit more? Did they change that?
Yeah.
Some things recently with that?
So
How long is it?
Yeah, so the Public Service Loan Forgiveness Program, they recently made a few changes on that, and it's so if you want to see the details of the changes, again, go to studentaid.gov. As far as I know, it's still, I haven't really dug deep into that just yet. So as far as I know, that if you are making payments, so I think the changes you're referring to is that when people are making payments before and they weren't calculating towards that the 10 years. Is that what you're referring to? So now that the Department of Education has really rolled back or to have people calculate that they were making more payments than they were being given credit for. So I think it was up to like 860,000 people that had their loan forgiven because all the payments they were paying before, some things like 10 or 20 years ago, weren't being calculated as part of their regular payments towards the PSLF program. So about 806. So once they reviewed that and they fixed that with the calculations, they forgive their student loans to about 860,000 people. But as far as I know, the PSLF program, Public Service Loan Forgiveness Program, Mayo is eligible for that if you work for Mayo, because you are, Mayo is a nonprofit organization. If you work at least 30 hours, which is considered full-time, to be eligible for the PSLF program. And you just have to apply into the program, get accepted, and recertify each year, and then continue making your monthly payments until the 10 years is up. So, as things change with the PSLF, we'll update that as well. Any other questions? No? Okay, perfect. And again, you can visit our website, mayocreditunion.org, student loans, if you have any questions about student loans. And again, my name is Sokha Yus. I'm a financial wellness counselor here. My phone number and email is listed here, but you can also go to our website and email me directly as well, or email the credit counselor inbox as well. So if we don't have any questions, we'll go ahead and wrap it up here.